Assalamualaikum and hi everyone. Welcome back to the lecture 2 of MFRS 140 investment property. In this session, we are going to look first at the recognition of investment property. We will start off with the recognition criteria. So the recognition criteria of investment property is the same as MFRS 116 PPE, where it will be recognized as an asset according to the MFRS when and only when it is probable that the future economic benefits that are associated with the investment property will flow to the entity. And also when the cost of the investment property can be measured reliably. So the cost here refers to the initial cost or the cost that would be carried as the carrying amount of the investment property. So it shall be measured reliably. So this is similar, as I mentioned, to the rules under MFRS 116. So what are future economic benefits associated with the investment property? So the future economic benefits are likely to be in the form of rental income, which is actually income to the reporting entity when they have their building, for example, to be rented out, or if they invested in a property and they wait for the property to have the rise in the price, or that is what you call speculative motive, so that will have appreciation in the value that is going to be also associated with the potential future economic benefits. So rental income and the appreciation, where that is capital appreciation, since this is a capital asset. Next is about subsequent costs. These are similar to MFRS 116, where whatever day-to-day servicing costs will not be recognized as part of the initial cost, and also that will not be recognized on subsequent costs. So every reporting date, you are going to look at that, and that will not be included in the carrying amount. However, the cost to replace parts or the component of the original property or the building being used for investment purpose, it will be recognized in the carrying amount of the investment property if they meet the asset recognition criteria. It met the criteria. So initial measurement, it is very similar to the rules under MFRS 116, where it is measured at cost. And the element of the initial cost comprise of the purchase price and any directly attributable costs similar to MFRS 116, brokerage fees, professional fees, legal services, property transfer tax, because you are going to transfer sometimes property that will also incur stamp duties, for example. That is an example of transaction costs. That is part of directly attributable cost to prepare the property to be ready for its intended use to be occupied by the so-called tenant, the occupants. Initial costs could be also at the cash price equivalent, where payment is deferred. Let's say you purchase now, but the payment is deferred beyond the normal credit terms. The cost would be the present value of all future payment, meaning that the future value, the future payment discounted to the day of initial recognition. Similar under MFRS 116, where you have asset purchase with a deferred payment. The cost or the initial cost will also include the cost to acquire investment property, as well as the subsequent, it will also include costs that are incurred subsequently to add the property, replace parts, service the property. So therefore, this will be part of initial cost. The cost, however, will not be included in the carrying amount of the IP, and should be expense of in the profit or loss. So expense of do not include, so exclude. The startup costs do not include this. Initial operating costs or losses, unless that is necessary for the startup costs to bring the property to the condition that it will be capable of operating to the manner intended by the management, but it should be excluded. Yeah, the startup cost, if it does not fulfill that criteria, abnormal amount and initial operating loss, abnormal amount of wasted material, labor, or other resources that were incurred to construct or develop the property. Next, we are going to look at the first problem, which is a company called Tanjung Tualang Berhad on 1st of January 2000X1 acquired. So this is the date of acquisition, where you acquire an investment property in the form of building for 22 million. So this is the purchase price. So you need to go and check whether the purchase agreement, what does that include. So here you have the settlement to be settled by 31st of December. So it was purchased on 1st of January, but the future payment is on 31st of December, where you are given the discount factor of 10%. So you need to know what are the present value of this future payment, right? So you need to go and discount 22 million to the present 1 year earlier. So 2 million was paid for transfer and stamp duties, 2 million. 22 was the purchase price, but you need to go and discount them. So company also incurred 40,000 for the legal fees and also incurred 200,000 for this 31st December 2000X1 for rates. So let's see what are the requirements. You are asked to measure the initial cost to be recognized by the reporting entity upon initial recognition as the building that is now an investment property. So let's look at the calculation here. So the purchase price is at the cash price equivalent. So we are now trying to know what is the present value. So that is being discounted, the future value being discounted to the present. So this is the future value, 22 million, discounted to the present. So 1.1 is actually 110%. So you divide it by 110%, the discount factor, because the discount is 10%. You get 20 million. So then you have transfer duty and also stamp duties. So include this. That was a directly attributable cost. So that is 2 million. Here is not 22 but 20 after we discount them. Legal fees 40 and rates are not included because rates are the subsequent costs that will not meet the recognition criteria. It is an operating cost and it was expense off to the SOPL. So therefore it was being excluded. So the initial cost was 22.04 million.